Monday morning markets are open. I'm Patrick in Vancouver. Today is April 20th, 2026. Monday means fresh setups. Let's break down the week ahead and find our edge. Quick reminder, everything we discuss here is for education and entertainment. Our practice investments use simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Narrow earnings revisions are powering S&P records, while commercial vacancies drop for the first time since 2020. Let's start with the market pulse. The S&P 500 closed at 7,126, up 1.2%. The NASDAQ Composite reached 24,468, up 1.5%. The TSX Composite finished at 34,346, up 0.9%. This selective strength comes amid upcoming United States retail sales, purchasing managers index, and inflation data. We also have Canada's March Consumer Price Index released this morning. Our simulated portfolio sits year-to-date at negative 0.02% versus the NASDAQ Composite year-to-date at positive 5.31%. That delivers an alpha of negative 5.33%. That narrow breadth is exactly why we are focusing on specific analyst revision pockets today. That also created the perfect setup for our flash trade. Today, our practice investment of the day is a flash trade on CLDX, Celldex Therapeutics. This is a simulated trade for educational purposes only with no real money involved. Barclays delivered an upgrade after successful Phase 3 data in chronic spontaneous urticaria. The firm also noted that enrollment in the EMBARQ trial finished 6 months ahead of schedule. They lifted probability of success to 85% from 65%. Peak revenue estimates were increased along with a new $45 target that carries conviction. We assign medium confidence to this setup. The strong catalyst and positive reaction sit inside a NASDAQ day that rose 1.5%. Yet it relies on a single factor without full volume or sector confirmation. We set a maximum 8% intraday stop to maintain discipline. This trade demonstrates how to filter high conviction revisions that are backed by concrete trial acceleration. Listeners learn to act opportunistically on these updates while respecting flash trade position sizing in volatile healthcare names. This analyst upgrade momentum play fits perfectly into the broader strategy spotlight on where revisions are actually moving the market. Goldman Sachs has observed that concentrated upward earnings per share revisions in select sectors have driven S&P records. This has occurred even as overall market breadth remains constrained. Today's conditions make the strategy relevant because upcoming inflation and retail data could widen or narrow those revision pockets. To implement, screen for the largest 12-month upward earnings per share revisions on broker platforms or free tools on sites like investing.com. Layer in volume trends and Canadian tax implications for TFSA holdings. This strategy has worked best historically during late cycle or low breadth periods. A handful of names can carry the indices in those regimes and deliver outperformance versus equal weighted benchmarks. Risks include sudden revision reversals if the upcoming data disappoints. That could create concentrated drawdowns in the affected names. To execute these revision-driven ideas successfully, we need solid technical timing. That is the focus of today's discussion on technical analysis fundamentals for modern investors. Imagine you bought an energy stock this morning on what looked like a breakout above its 200-day moving average after oil futures climbed. It stalled at resistance and gave back 3% by afternoon. The 200-day moving average often acts as dynamic resistance in choppy macro environments. The 50-day moving average provides shorter-term trend context. Golden crosses and death crosses fail more than 40% of the time in range-bound markets. Support is a price zone where buyers historically step in. You can see it through multiple bounces from that level. Resistance is the opposite zone where sellers dominate. Both gain reliability when aligned with the 50-day or 200-day averages. The 14-period RSY above 70 signals overbought conditions that often precede mean reversion. Below 30, it flags oversold bounces. MACD tracks momentum shifts via its signal line crossovers. Volume confirmation matters greatly. If a breakout occurs on 1.5 times or greater the 20-day average volume, it succeeds roughly 65% more often. The pro tip most retail investors miss is that professionals always require at least two confirming indicators. An example is RSI oversold plus rising volume at support. They also respect the higher timeframe charts such as weekly versus daily to avoid false signals. The biggest mistake is treating technical analysis as a crystal ball instead of a timing overlay. Always pair it with a fundamental catalyst and predefined exit levels before entering any position. These same technical filters would have helped us evaluate yesterday's weekly hold. Our last weekly hold on LUCID could not be evaluated due to unavailable market data. The running total stands at negative $2.16. Our win rate is 30% with 3 wins out of 10 trades. Cumulative profit and loss is negative $2.16. Alpha versus the NASDAQ could not be determined due to the unavailable pricing data for the holding period. This teaches us that absence of reliable pricing data blocked proper tracking of whether the robotaxi thesis outperformed the NASDAQ. Rule: verify data availability from multiple providers before declaring a weekly hold closed. Reliable data and timely information are also why the tools we highlight today can give retail investors an edge. The Investing.com analyst ratings aggregator surfaces fresh conviction shifts. An example is Evercore ISI reiterating IBM after its first quarter beat. It lets individual investors scan for these moves across hundreds of names daily. The tool delivers edge by surfacing specific rationales faster than waiting for full reports. This is especially useful in narrow revision markets like the one we are in. Canadian investors can use the free tier via browser or app to cross-check with TSX listed peers before TFSA entries. Premium unlocks alerts for faster monitoring. The Raymond James Research Portal delivers concrete targets for sector-specific calls. Examples include reiterating strong buy on Expand Energy with a $145 target and coverage on Antero Resources. It enables targeted energy rotation without broad index exposure. Retail users with Questrade or Interactive Brokers can access similar research tabs at no added cost on approved accounts. Combine the targets with your own free cash flow analysis and Canadian tax account implications for best results. These research tools can also help you act on the macro shifts we are seeing in our final quick hits. Canada's office and industrial vacancy rates declined simultaneously for the first time since 2020. This suggests the commercial real estate sector may have reached a recovery inflection point. Consider adding Canadian commercial REIT exposure via TSX listed vehicles in your RRSP if national vacancy data shows further improvement next quarter. Ottawa's temporary fuel tax suspension begins today. It delivers approximately 10 cents per liter savings on gasoline and 4 cents per liter on diesel. Monitor for upstream demand pressure on energy producers in taxable accounts. If sustained lower pump prices reduce demand signals over the next month. Equities continue advancing on surface level optimism while bonds show divergence on elevated yields and shifting rate cut expectations. This week's retail sales, purchasing managers index, and inflation data are likely to resolve the disconnect. Rotate 10% of an equity portfolio into utilities or floating rate notes if bond yields stay elevated through Friday's close. One reader question highlighted a $3.2 million early retirement portfolio where only $200,000 sits in a traditional IRA. The investor holds roughly $506,000 in a Roth IRA alongside mostly non-IRA assets. This demonstrates effective tax diversification across account types. Conduct a Roth conversion ladder analysis in your FHSA or RRSP before age 59.5 to replicate similar tax minimization in your own retirement drawdown plan. Our simulated portfolio currently shows 10 total trades. The win rate sits at 30% with 3 wins, 3 losses, and 4 break-even outcomes. Cumulative profit and loss is negative $2.16. Average return per trade is negative 0.02%. Our best trade delivered 7.88%, while the worst was negative 7.49%. The current streak is even. Our AI analysis is learning from these patterns and adjusting parameters for the next set of opportunities. This remains a learning journey that highlights both the power and the discipline required with modern tools. Now, here is something that most retail investors get wrong about technical analysis, and it cost me money before I figured it out. You can have what looks like a perfect moving average breakout, but without a second confirming indicator, it often fails. Professionals never rely on a single line on a chart. They demand alignment, such as an oversold RSI reading combined with rising volume at a support level that also sits near the 200-day moving average. They check the weekly chart first to ensure the daily signal does not fight the higher timeframe trend. The concrete misconception is believing technical patterns alone can forecast direction with high accuracy. The fix is to treat technical analysis strictly as a timing overlay that must sit on top of a clear fundamental catalyst and a written exit plan. When you enforce that two-indicator minimum plus catalyst rule, your win probability on short-term trades improves meaningfully. That is the practical edge you can apply in your own TFSA or RRSP starting this week. Before we wrap, keep an eye on how the inflation and retail sales data influences those narrow earnings revision pockets tomorrow. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.